I was just checking the latest data, and the unofficial estimate is that close to 50 billion has come in. At least we can anticipate a flow of around 80 to 90 billion on the FCNR. Of course, in this, we have to see how much is incremental and how much is just rotation of deposits from existing schemes to the new scheme. Even if we assume that 50% of that will be fresh, so that's now roughly around 40 to 45 odd billion.
Hello and welcome to Macro Decode. The Reserve Bank of India has opened a special window to attract foreign currency deposits from non-resident Indians. By easing norms for FCNR and NRI deposits, the RBI hopes to strengthen the country's foreign exchange position and provide greater stability to financial markets. But how successful has this initiative been in achieving these goals? We have Anindya Banerjee, Head of Commodities and Currencies at Kotak Securities, to share his insights on this. Welcome to the show, sir.
Thank you for having me.
So the RBI has launched this series of measures to encourage FCNR and NRI deposits. How has the response been so far? Have banks been able to mobilize the expected amount of foreign currency till now?
As of now, the trend is clearly indicating that it will be much more than what the market was anticipating initially. So it can easily cross 70 or 80 billion dollars and get closer to that magical number of 100 billion. I'm not saying exactly 100 billion will come, but get closer to that.
Okay. So have these measures primarily attracted fresh deposits, or have they merely shifted, existing NRI deposits from one bank or one scheme to now?
Switching of the nature of deposits will happen, but it can't be that the entire 70 or 80 billion, if that number comes in, or 90 billion, will be just switching of deposits. Fresh amount has also come in, and it's quite a sizable one.
Okay, so is there any kind of numbers that the RBI has given us to how much is the fresh deposit?
I don't think so. The RBI has yet give out a number how much is fresh. But see, if you look at the old structure, the interest rate differential between the rupee deposits, means the
Right.
FCNRB deposits, and dollar deposits in international banks, was not that attractive, because the banks had to bear the hedging cost. So naturally, it didn't attract much flows. Now that thing has become quite attractive, and now they're offering very high rates means the rates are almost as good as the FD rates on the rupee deposits, right? Plus, a lot of this money is coming through the structured product route, which means it's a kind of a leverage structure, which even the Indian banks are offering.
How attractive are they for an NRI probably investing in parking in Indian banks?
Some banks are even offering 7%. Right. So if he's able to get a funding of around 5.5%, so it's around 150 basis points plus the leverage. Okay. If the leverage is 6 times, it is 9%. If it is 10 times, it is 15%. So those kind of structures are there. So that's the reason why the flows have been quite good. Let's take a case where somebody is actually borrowing the money. They are being offered leverage. Means if you put up $100, you would get $1,000 exposure.
Okay. Are the higher interest rates offered by banks primarily funded by the regulatory concessions provided by the RBI, or were the banks willing to sacrifice part of their margins? Because now this after this window that has been open, attracting foreign currency also has become strategically important.
I don't think so, because as I said at the start, that what has happened is basically the dollar FD rates, if I take that as a FD, fixed deposit, has become equivalent to the rupee FD rates for banks and for financial institutions, right? So generally that's never the case, because you have a hedging cost.
Okay.
Let's take 7% is your FD rate, rupee FD rate, and 1 year hedging cost of USD/INR is, let's assume, 4%. Just I'm saying, just as a ease of calculation. Right. Then ideally, your dollar deposit rate should be around 3%.
Okay.
So, but that's not the case, because RBI is saying that I will take that risk. You give the dollars to me, I'll sell it back to you exactly at this exchange rate. So I take that risk. So the banks can easily offer the same rupee deposit rate on the dollar deposit rate without sacrificing anything.
So if you compare with the response of non-resident Indians this time with the earlier instances when the RBI provided similar special windows, what do you think has been the response?
See, the situation is totally different. In 2013, we were part of the Fragile Five. As a depositor, when you are investing in a debt product, you are not so much, you don't have the benefit of a structural growth story or a reform story. That's an equity play. Only thing that matters is the safety or the credit risk of the banks.
Right.
Means the Indian banks are one of the most sound financial institutions in the world. So as far as that is concerned, I think the NRIs will have complete comfort. I think it's a great opportunity. I doubt in future if they would ever get this kind of opportunity to to get these kind of yields. So I think a lot of them are taking benefit because it's a 3 to 5 year window. Means
While announcing this special window, the target was to improve market confidence, strengthen rupee and external position. Let's look at all these goals separately. Have these measures, first of all, improved the market confidence, particularly among global investors and rating agencies? I'm saying because we have seen that FIIs and FDI had been losing confidence in the Indian market. So has this kind of a measure improved their confidence?
See, these particular measures have definitely boosted the confidence, because if you see the FPI flows, they have turned positive. Actually, the kind of measures the RBI and the government has taken on the debt front by allowing the FPIs a bigger access, because it will be all necessary for the Indian bonds to become part of the other major global indices. So I think that, along with the stability in the rupee, has definitely played a role in ensuring that the foreign investors come and start investing in the debt and the equity markets.
Right. And what about the external position? Has it strengthened India's external position?
Impact is on the FX reserve as long as RBI is mopping those flows, right? So definitely it has led to a situation where the RBI is going to get a substantial chunk of this flows. Whatever is a fresh deposit. I was just taking the latest data, and the unofficial estimate is that close to 50 billion has come in. So with 1.5 months to go, we could easily see this the number get to 80 or 90 $90 billion. So that will be substantial addition to the FX reserves of the RBI. And so definitely it will have a positive impact on the external position. Now coming to current account, see, directly, this is a capital account flow. So it will not impact current account directly, but it has indirect impact on the current account over the tenor of the deposit, because the interest payments which need to happen, which be a current account item, which will be an outflow. So that will be negative, but again, that is not really an issue as of now, because that will be spread over the next 3 to 5 years.
Recently, IMF also has mentioned that in FY27, we will probably see our current account deficit going up to 2%. If you look at the kind of outgo that we would probably see in 3 to 5 years, in this kind, will we see a higher current account deficit?
So 2% would mean a current account of close to, I think, 80 odd billion. If I take a 4 trillion GDP number, we can anticipate a flow of around 80 to 90 billion on the FCNR. Of course, in this, we have to see how much is incremental and how much is just rotation of deposits from existing schemes to the new scheme. But I think at least, even if we assume that 50% of that will be fresh, so that's now roughly around 40 to 45 odd billion. So that, I think the current account funding is well taken care of now, with also the FPIs turning positive. So I think that won't be a concern, even if the current account can be higher because of the oil prices. But again, this oil prices cycle is just linked with what's happening in Hormuz. So once that issue gets sorted out, I think that impact will also be gone, if not in FY27, in FY28.
But with this window, are we actually buying time on our external position?
We have enough reserves. So that's not an issue at all. So it's just that we are building up those buffers so that if things get out of hand in the coming times in West Asia, then an oil prices jump significantly, let's say $150 or more, then in that case, we can handle that kind of pressure. So these are like creating safety measures in times of extreme volatility in the world. So see, this is very different from 2030. 2030, India was in a deep soup. We were part of the Fragile Five. So then it was more about buying time. more about at least having some time on the hands so that we can get our house in order. So now it's more to ensure that when we have certain tools at disposal, I think it makes sense to utilize them.
Okay, what has been the impact on the of these deposits on the rupee? If you look at June and August now, rupee is almost in the same levels, and we have also seen the dollar index actually coming down.
The dollar index has come down by a bit, but not much. It went up to 101.5 something. Now it's hovering around 100. So you are right. The rupee is stable. It went down to 94 USD INR. Now has bounced back to 95.30. Now what is happening is this FCNR flows or the ECB flows, whatever is happening because of the concessional scheme, directly doesn't impact the market. It goes to RBI. Is when the RBI comes into the market and intervenes, then the dollar flows into the market. So I think that's the reason why. And RBI didn't want to create a sharp decline. They wanted to basically create a stability in the currency, because if you create a sharp decline in your currency, you lose the trade advantage, because global trade war is going on. So you don't want to be the country with a very strong currency at this point in time, because it can hurt your exporters. So I think RBI is playing that stability game. Inflation is not a problem, so we can afford to play the stable rupee game than a very strong rupee game now.
Right. But when we look at trade, actually, we are more on the import side. Whenever our rupee weakens, it's actually detrimental for us rather than being beneficial. That other thing is, like, forex reserves that we have is around 690 billion, which is much comfortable if you look at the kind of times when we had a crisis on forex. So overall, what were the benefits of these measures that economy would have had?
So basically, it only adds to the dollar reserves of RBI, right? So it gives more ammunitions to RBI to intervene in the market. So that's what it does as far as the RBI is concerned. Apart from that, there is no direct. Yes, it infuses the banking liquidity. All those things happen. But I think the direct impact is on the dollar availability. It creates a sudden influx of dollars in the system. It's like if instead of this, if $90 billion would have flown into your tech market, the same thing would have happened.
Right. But after 3 to 5 years, we will also see a outgo on this.
Yes, but again, I think a 3 to 5 year cycle, if we have to take a call, we should not extrapolate the current cycle, because when we look at a lot of other, then we have to look at the global cycle. Dollar is going through a de-dollarization phase, very rapid de-dollarization phase. At this time, a point will come when, even if you look at the fact that America is closing its borders to goods, to people, to everything. So it's trying to become a more producer-oriented economy for a consumer. It's not easy, but at least the thing that they need over the next 3 to 5 years is substantial dollar devaluation to get to that point. So I think that phase might also play out. So I think 3 to 5 years, we have to see how things pan out, whether these, because even in 2013, RBI made some handsome profits in their deal. Right. So we should not extrapolate the current phase and say it will be like this, because there are a lot of other factors at play, and the whole cycle just could flip. We could go from a strong dollar to a very weak dollar.
Was it actually necessary at this point of time to raise this kind of an NRI and FCNR deposits? If you look at our forex position wasn't that bad.
I think standing at that time when it was still not clear as to how things will shape up in West Asia, it was important. It's like taking a call in, let's say, October of 2020. You don't know that the things will end with a Omicron, right? So you had to make your best move based on the information which is available at that time. I think the RBI took a right call, because, as I said, there is no harm in having some few extra dollars at your disposal, because if things go bad in the world, then you have that extra cushion, because you cannot create that cushion at that time. Always take insurance when the insurance is available.
So that was Mr. Anindya Banerjee talking to us about the special window RBI has opened for NRIs to make deposits in FCNR and NRI deposit accounts. Thank you for joining me on the show, sir.
Thank you.